ahead. I think you're go ahead and get started.
Okay, this is Paul Gallagher. I work on the LaRouche EIR economic staff and also on the certain amount on the mobilizations and meetings in Washington to get Congress to act. And I'm assuming that we are joined here on this discussion by a number of other people who are also active in this same mobilization in various parts of the country, various ways. So we're going to discuss Glass-Steagall and why we need to get it restored. First, let's get it in context. We have been mobilizing around four pieces of policy legislation, four laws, which Congress has to enact and has to do it quickly. Linda LaRouche laid these out 3 months ago, a little more than 3 months ago, 4 months ago in March. And we have been mobilizing around this since that Congress, we have to get rid of Obama, get him out of the presidency that's bound up with these four urgent policy actions that Congress has to take. We have to get them to take, but bound up with that is getting Obama out. He's an instrument, a puppet, you might say, of the London and Wall Street financial interests who are against this entire policy that we're mobilizing for. We have to get him out. And then Glass-Steagall must be restored so that the international banking system, the transatlantic banking system, does not crash again worse than it crashed 6 and 7 years ago. Glass-Steagall has to be restored urgently before that happens, and already in recent weeks, and particularly in recent days, we've been seeing the first harbingers of that recollapse, that second and more devastating collapse of transatlantic banks popping up in various countries in Europe, in Bulgaria, in Austria, in Portugal, most seriously recently. We have to get the Congress to create a national credit system, one in which a national credit bank facility cooperates with private banks around the country which are under the direct regulation by the Treasury, so as to create and disseminate large amounts of credit into industry, manufacturing, households for an economic recovery. We have to invest a great deal, including through this credit mechanism, invest a great deal in truly high technology and science-driven infrastructure projects, including mega projects, which solve the most serious economic problems that the country faces, as, for example, the extreme and worsening drought across the western half of North America, the devastation of the eastern and southern coasts of North America by storms and superstorms in the last decade, infrastructure projects, including mega projects that solve those most basic economic problems and thereby unleash productivity in the labor force and in the economy. And we have to drive this scientifically and technologically by a policy of urgent crash development of fusion energy, thermonuclear fusion energy, fusion and fission technologies, in order to really provide the greatest increase in productivity and drive for the recovery of our economy. We have to do these things, these four things for our economy, but obviously the United States is also a very important nation in the world, and that is a part now of the context in which we're fighting for this, including the restoration of Glass-Steagall. In the course of the last week, major nations of Asia, together with some nations collaborating with them in South America, but fundamentally the three major powers, economic powers in Asia, China, Russia, and India, have initiated banks, two infrastructure development banks, which start on a scale of $100 billion in credit each, in capital and lending capability each, and will grow from there. And one which will start operations in about 5 months, and the other within the year after that. And they made very clear in their summits during the course of the last week and their meetings between individual heads of state that these banks were going to lend that credit for infrastructure development, including mega projects of infrastructure. This was not going to go for funding anti-poverty programs. It was not going to go for mitigation of climate change and things of that sort, like the World Bank does now. This was going to go for the kind of infrastructure that drives growth. Now, you look at these countries, they have been, compare them. The United States and the other countries of what's called the OECD, which is basically the United States, the industrialized European countries, East and West European countries, and Japan. Those countries, in the last 6 years, have grown, even according to the GDP measure, by a total of 11%. 11% in 6 years. That's a rate of just over 1% a year. And during the same period of time, the household income, on average in those countries, has dropped by about 4% over those 6 years in all of those countries combined. While, of course, as is well known, their stock markets have gone through the ceilings and set records of every kind. But that growth has been essentially non-existent. At the same time, the economic powers which are creating these new international development banks have been growing at rates of 5 to 8% every year, each one of them. Why? They have been investing large amounts of credit, and this is particularly true for China and countries being assisted by China in this, large amounts of credit in building 3 high-speed railroad land bridges entirely across the Eurasian continent, from the Pacific coast to the Atlantic coast and the English Channel, in building out nuclear power sectors in countries all across Eurasia, in building a new, now announced, building a new second Panama Canal. The announced intention to, and China will do it quickly, to build high-speed rail in the other direction, north to the Bering Strait, across Siberia to the Bering Strait, and under the Bering Strait, and come out in Alaska, waiting for the United States and Canada to pick up that high-speed rail track there. Exploration of the moon, exploration of the orbits of Mars, development of nuclear, development of some of the most advanced and operational thermonuclear fusion development experiments in the world. It's no wonder that this is producing, the credit for these purposes are producing growth in stark contrast to what we have been suffering through over the last decade and more, the last 3 miserable presidents. So these banks are clearly a tremendous opportunity for the United States to form a credit system of its own, and having created that credit system, to join in this international investment in the most important and scientific driver infrastructure projects in the world. Why Glass-Steagall is absolutely necessary to start this process, when you consider these banks have been each started with the Asian Infrastructure Investment Bank is one of them, the new development bank formed by the Brazil, Russia, India, China, South Africa combination, the BRICS, as it's called, starting with $100 billion in capital each. This, compared to the need for infrastructure investment in the world, including the very pressing need, is tiny. This is a tiny amount. We need infrastructure investment in this country on the order of $3 trillion alone. This is a very tiny amount. It will grow. It will certainly grow rapidly, particularly through the issuance of credit to these banks by China, which is in a position to do so. But it is desperately needed that the United States contribute credit, which it creates through a national credit system, into these international development banks. And in addition, we need to receive that, we need to invest that credit. We need those investments in infrastructure as urgently as any other country in the world that could come from those banks. So we need to participate, this nation does. If those two development banks grow rapidly with the United States remaining opposed to them, the Obama administration has been opposed to them. It has been trying to prevent countries from participating in them. If they grow rapidly with the United States opposed to them, the tendency will be to have the effect of causing the dollar to be drastically devalued. You could use the phrase dollar collapse, but it would be more precise to say a drastic devaluation of the dollar on the international scene. That would, if it occurs, make the United States less capable of contributing to progress, scientific and technological development, infrastructure investment in the world as a whole. And in addition, it could get chaotic. Now, China clearly does not want the dollar to collapse or to be drastically devalued. We don't need to go into the reasons for that. China clearly doesn't want that. Therefore, the United States opposition under Obama to these development banks holds them back. We have to regain control of the dollar away from Wall Street in order for this great project of future development to work for nations around the world. The dollar has belonged to Wall Street for 50 years. The vast majority of dollars have circulated outside the United States, have been invested in assets outside the United States for 50 years. The last president who tried to reverse this or wanted to reverse this said in discussions with his advisors that he wanted to reverse this was John F. Kennedy, who wanted to reestablish the credit controls, currency controls, and capital controls of the Bretton Woods system, which had already been allowed to lapse when he was president. Since he was killed, no president has taken this up. The dollar has become and is today London and Wall Street's dollar, not the United States dollar. And unless we regain control of it, and this is where Glass-Steagall is absolutely urgent, unless we regain control of it, we will not join and share in the tremendous future benefits of these development banks and the credit that they generate, and also we will hold them back. We will constrain what they can do for the rest of the world. So, and we will, of course, be happy to continue to bump along with zero growth, even in our GDP, or negative growth as we had in the last quarter. So we need to change that. We need to get Obama out. Now, we start with Glass-Steagall. And if we regain control by breaking Wall Street with the restoration of the Glass-Steagall Act at this point, breaking the hold that it has over dollar and dollar credit, then we can proceed through the initiatives, the four initiatives that are embodied in these four laws that Lyndon LaRouche laid out in March, and which we're mobilizing around. So that's the urgency of Glass-Steagall. Most people talk about the urgency of it as preventing another crash. That's obviously, if we don't reorganize the banks under Glass-Steagall reorganization before this oncoming crash hits, it will be very, very difficult to do it afterwards. We will be starting with a collapsed financial system in the transatlantic world. We will be in bad, bad shape indeed. We need to do it for that reason. That's the reason most people talk about it. But we also need a banking system and a dollar system of credit which functions and which is controlled by the United States government controlling its currency and not by London and Wall Street. So Glass-Steagall, as most people know, came into law June 16th, 1933. The banks prior to that period, during the 1920s and beginning of the 1930s had used their deposits. The biggest banks had used their deposits for speculations in stock in particular, including their own stock, as they are doing now. They had used them for speculations in the securities markets. And they had created a situation where from 1929 on, 1/3 of all the banks in the United States went under, disappeared. Another third were saved during the bank holiday of 1933 after Roosevelt took office only by the issuance of new credit, new currency to those banks if they were in bad shape but salvageable. And as I said, a third simply collapsed. Once that reorganization was done during the bank holiday in March of 1933, then it was clear that deposit insurance had to come. The Federal Deposit Insurance Corporation had to come. People had been wiped out. Households by the millions had been devastated by the collapse of all these banks as a result of their speculations during the previous decade with their depositors' money. Deposit insurance had to come, and it was realized by the Roosevelt administration immediately, as well as by the further looking in Congress, that you simply could not give deposit insurance or banking insurance and federal protection to investment banks which were speculating with their partners' money and engaging in risky speculations which could wipe out everybody and lose everything. You could not have the federal government guaranteeing that. Therefore, that kind of activity, those kind of institutions had to be rigorously separated away from the commercial banks which took people's deposits and mediated those savings into the economy, and thus the Glass-Steagall Act. Mr. Glass, Senator Glass of Virginia, was a voice of Wall Street, and known as the father of the Federal Reserve. If it had not been for the fact that Roosevelt pushed forward hearings in 1932 and 3, which disgraced and removed some of the key CEOs of the biggest banks in the country as a result of those Pecora hearings, and they were replaced at the top of those big banks by other bankers who were favorable to Glass-Steagall, and in fact began in a couple of cases to split their banks up break them up even before the Glass-Steagall was passed. If that hadn't happened, Carter Glass would not have been associated. It would not have come within 1,000 yards of the Glass-Steagall Act. But it passed in order to make this separation. And for 65 years after that, the United States did not have at any time a bank failure which triggered other bank failures. In other words, a bank panic. Clearly, it had bank failures. It did not have a bank failure which triggered any other bank failures for 65 years after that bill was passed. That was its purpose. And its purpose further, beyond this separation, commercial banking, taking deposits, investment banking and what's called broker dealing, speculating in securities and issuing securities, and insurance underwriting. Those three things were separated completely by Glass-Steagall. Secondly, it made a rule that no bank which was a commercial bank, insured, taking deposits, regulated and protected under the Federal Reserve System, no such bank could invest more than 2% of its capital and surplus into securities. To take an example, JP Morgan Chase today, we're taking an example from the present day, but it makes it clear. JP Morgan Chase today is supposedly a $2.5 trillion bank. That's its assets. It brags that its capital is $400 billion. Its surplus, or that is the profit it makes in a year, has run as high as $40 billion. So let's say it's $40 billion. Then its capital of 400 billion plus its surplus in a very good year, $440 billion. Under Glass-Steagall, no more than 2% of that could that bank invest in securities. 2% of that amount is about $9 billion. By 1994, through a series of unilateral changes in the Glass-Steagall law, which it did not have the authority to make, Alan Greenspan's Federal Reserve had raised that percentage to 25%. So for JP Morgan Chase, 2% was 9 billion, 25% was 410 billion. That's quite a difference in terms of the ability of that bank to throw its depositors' money into securities speculation. That's the difference that was made before Glass-Steagall was formally wiped off the books in 1999. But just before that happened, because of what Greenspan had done, there was a failure which almost brought down the entire transatlantic banking system. It's not perhaps that well remembered now, but the long-term capital management company, which was a very big hedge fund for that time, had received loans. It had a capital of about $1.5 billion. It had received loans from banks, which they would not have been allowed to make under Glass-Steagall when enforced, because the 2% rule applied not only to direct securities that bank might buy, but also the bank had to stay under that level of what it might lend to a firm that was going to issue securities, like a hedge fund. But 55 different banks had loaned $140 billion to this hedge fund, which had as its own capital $1.5 billion. So it was loaned up 100 to 1 by commercial banks, and it had derivatives outstanding of over $1 trillion when it failed. And that failure in January and February 1999 had the transatlantic banking system at the point of the kind of collapse that occurred in 2008. It was saved by a bailout, which was kept very private at the time, and which the banks themselves were made to do the bailout by Alan Greenspan. But he himself acknowledged later that the banking system was at the point of destruction when the long-term capital management went under. That was the canary in the coal mine, the warning right away that the breakdown of Glass-Steagall that Greenspan had done had already created a situation in which speculation in securities with huge amounts of money from commercial banks, depositors' money, could create a crash. Now, then look at the growth of derivatives when Glass-Steagall was taken down by Greenspan and in the middle 90s, and then actually repealed by the beginning of 99. In 1994, the total derivatives exposure worldwide was 17 trillion. Now, that's quite a bit. It's the U.S. federal debt right now, public and private, but that's what it was in 1994. By 1997, after Greenspan had broken Glass-Steagall open by this 25% rule, the exposure of derivatives internationally was 77 trillion, not 17 trillion anymore, but 77 trillion. Then there was the failure of that hedge fund as a warning. But by 2002, after Glass-Steagall had been wiped away entirely, the derivatives exposure internationally was 280 trillion compared to 17 trillion 8 years earlier. By this time, keep in mind, there was no 2% rule anymore. There was no 25% rule anymore. A bank like JP Morgan, with its 2.5 trillion in total assets, in this period has 40 to 60% of them invested in securities. So you do the math. You're talking about 3.5 to 4 times the total capital of that bank is invested in securities. And the derivatives bubble was growing as the commercial banks poured depositors' money into it. By 2006, the derivatives exposure, and in every case here I'm taking the figures of the Bank for International Settlements, just so you see the trend, not to claim the accuracy of these figures, but just so you see the trend. By 2006, the exposure was 600 trillion. We were now just about a little over a decade out from when it was 17 trillion. It was 600 trillion in 2006. It is, as of the second quarter of this year, the quarter that just ended, 715 trillion and growing at a rate now. There was quite a dip after the crash in 2008, but it's growing at a 15 to 20% per year clip at this point from what the Bank of International Settlement says is $715 trillion. What are these things? These are, in every case, it starts with an investment bank or a similar institution issuing a security. It can be a very complicated security, but it's a security. And once it is issued, everybody bets on it. And those bets are the derivatives. But it always starts with the issuance of a security. The banks from the middle 1990s were claiming, and still to this day claim, that derivatives are not securities. They do this in order to throw regulation away, to leave derivatives completely unregulated, as they have been since the Gramm-Leach-Bliley Act, which destroyed Glass-Steagall. They say they're not really securities, they're not really futures, and other nonsense. They are securities. Every derivative, virtually every one of the $700 trillion to $1 quadrillion, is more likely figure, of derivatives is bets which are placed on a security which has been issued for the purpose of those bets being made. And you'll say, of course, right away that, well, there are not $700 trillion worth of securities outstanding in the world. That's true. That tells you that every security has a lot of bets being made on it. And for example, before the credit default swaps securities bubble collapsed and contributed greatly to bringing down the financial system 6 years ago, it had reached a total size of $65 trillion worth, quote unquote, nominal worth of derivatives, and they were based on 5 trillion worth of securities. So it was 13 to 1 in that case. There were 13 times the bets placed on every single one of those securities that were supposedly being insured by these credit default swaps. So that's the game. And the amount of that 700 trillion, 1 quadrillion, that's not the amount of the securities being bet on. Sorry, that's not the amount of the money that has been bet. That's the amount of the securities that has been bet on. And that includes many securities having been bet on over and over and over and over. And many derivatives which are bets on other derivatives, as in the mortgage meltdown of 2005 to 2007. There were lots of so-called, there was the securities, the mortgage-backed securities, the complicated securities which have been issued, and then there were the derivatives based on them, which were called collateralized loan obligations, collateralized debt obligations, credit default swaps. Then there were derivatives which were bets on credit default swaps. So no one can say this is not a securities business. When the banks go into this, they are investing in securities. Glass-Steagall prevents them from doing it and prevents the building up of this, stops and brings down the immense volume of sheer bets which have no connection whatsoever to economic activity. Absolutely none. Not even the most tenuous to economic activity. Cities and states around the country are paying on average every year now $16 to $20 billion in losing bets to banks and investment banks and broker-dealer funds which sold them derivatives on their bonds when the cities and the states issued their bonds. They made it a condition of handling these bonds that the states would make these bets. Now, another characteristic of the derivatives exposure is that everybody bets the same way, except for the few insiders. Everyone else going in and buying derivatives bets in the same direction. We know from the fixing of the LIBOR rates and from the devastation of cities like Detroit under these bets that it was fixed by London and Wall Street that almost everybody would bet the same way, and it would be the wrong way. And when it became clear enough that it was the wrong way, they would lose anywhere from hundreds of thousands to billions of dollars per agency, per city, per state on these bets. So this is what leaped from 17 trillion just before Alan Greenspan began to destroy Glass-Steagall to perhaps 1 quadrillion now, and within only a few years, less than a decade after his move against Glass-Steagall, had gone from 17 trillion in derivatives bets to 280 trillion, and then in a little over a decade to 600 trillion before the whole thing collapsed. Don't let anyone claim that this did not directly lead to the collapse. Deposit money was being poured into these derivatives markets by the big commercial banks, which were now allowed to throw unlimited amounts of depositors' money into that. And in addition, those big commercial banks were investing in, that is, they were betting in the same derivatives pools that the investment banks and the broker dealers were setting up. So therefore, when any one of these investment banks or broker dealers, it happened to be Bear Stearns and then Lehman Brothers, when any one of them went, it would trigger a true bank panic all around the transatlantic world. Every bank suddenly at the point of bankruptcy. So what happened? The isolated investment banks, like most famously Lehman Brothers, failed because no bailout was available to them. Others were bought up, like Merrill Lynch, by big commercial banks. And then the combination was bailed out mightily by the Treasury and the Federal Reserve. Others, which were standalone investment banks, Goldman Sachs and Morgan Stanley, were overnight by magical declarations of the Federal Reserve were turned into commercial banks, even though they had no deposits whatsoever. They were declared to be commercial bank holding companies. And so they could then be bailed out. And Bernanke admitted quite clearly to the commission that Congress formed to investigate this. He admitted very clearly that those two banks, Goldman Sachs and Morgan Stanley, would have failed if they were not brought into the TARP bailout by this magical conversion to being commercial bank holding companies. And the commercial banks themselves, the big commercial banks, were bailed out with $700 billion and then $3.5 trillion in money printing since then by the Federal Reserve. And that includes, of course, all the big banks in Europe, which have gotten a little more than half of all of that largesse from the Federal Reserve. And the Fed was already bailing them out in 2007 before the real bank panic began. Now, just the other day, in congressional testimony in the House on Wednesday, the new chairman of the Fed, Janet Yellen, shocked everybody in the Financial Services Committee of the House by saying that she saw circumstances where the Federal Reserve would just make liquidity loans and capital infusions directly into broker dealers, firms which had no connection whatsoever to commercial banks. That's something that even in the last decade has not been done. These banks, as everybody knows, are much, much too big to fail. In 1988, when Glass-Steagall was still fully enforced, the 6 biggest banks had 19% of the deposits in the U.S. banking system. By the time of the 2008 crash, they had 50%. I shouldn't have said deposits, I meant assets, of all of the assets. By the 2008 crash, they had 50% of all of the assets. By now, they have more than 60% of all of the assets in the banking system, those top six. And they are lending still, compared to what they had lent out 7 years ago, they are still lending out less than they were 7 years ago. The total lending of all banks in the United States has just now, in this month, finally returned to the level that it was 8 years ago. But that's because of increased lending by smaller banks. These big banks are lending even less than they were then. And as I said, pouring anywhere from 35, depending on which of the six, anywhere from 35 to as much as 60% of their deposit base into securities. So here's a chart. I don't know how well people can see this, but I'll just stick it up here in case you can. It's provided by the Federal Reserve. It's by the Federal Deposit Insurance Company, excuse me. And it shows essentially that in 1984, taking 1984, 30 years ago, as the starting point, at that time, the largest category of banks was defined as those which had more than 10 billion in assets. Of course, that would be tiny nowadays. But at that time, the largest category of banks was those with 10 billion in assets or more. And those banks have grown in size by 9.5 times in the 30 years since then. All other categories of banks that were smaller than 10 billion in assets back 30 years ago, all the other three categories of banks have all either grown almost not at all or shrunk in assets since that time. So essentially, these banks have come, the largest banks have come to completely take over and have effectively all of the assets. And the number of banks, which at that point in 1984, the total number of banks which could radiate credit out through the system, through the economy, was 10,000. As recently as 2007, it was 8,400. Now it's 6,900. These banks are constantly disappearing. Much more rapidly than they were failing a few years ago, they are disappearing now into the maw of the biggest banks. So when Glass-Steagall is restored, the behavior of the banks will clearly change. They will have a certain period of time in order to get rid of. In the case of JP Morgan Chase, for example, it has 3,154 different subsidiaries. One bank holding company, 3,150 subsidiaries, in only one of which is a huge commercial bank. It will have to get rid of all the others. They will fail. The great majority of them will fail. They have been created, the overwhelming majority of them have been created in the last 20 years at most. And they've been created by the diversion of deposit money through the violation and then elimination of Glass-Steagall, by the diversion of deposit money into all sorts of securities vehicles of every kind. Those vehicles will fail. You will see Wall Street crumbling on the implementation of Glass-Steagall, and we must mobilize our congressmen not only to restore it, to pass S-1282 in the Senate, H.R. 129 in the House, between them about 86 sponsors in the House, 12 sponsors in the Senate, not nearly enough. We have to get them not only to pass those bills and restore Glass-Steagall, but also to ride herd on its enforcement, so that it cannot be broken up, in particular by the Federal Reserve. And then you will see Wall Street crumble, and there will be an apparent shortage, as Helga LaRouche was discussing last night. There'll be an apparent shortage of credit in the economy. That credit was never there to begin with. And when I say that, I'm saying exactly the same thing Franklin Roosevelt said at a press conference in April of 1934. He said it looked, because they had reorganized the banks in this way, he said it looks like about $4 billion has disappeared out of the economy. But I tell you, that $4 billion wasn't there. It wasn't being loaned. It wasn't being used. Nobody was getting any benefit out of it. But now it looks like that $4 billion is gone. He said, we're going to have to put credit into the economy and replace it. Obviously, the scale today is entirely different. But the effect of breaking Wall Street in that way is going to be that we will absolutely need immediately to proceed to the creation of national credit. Not that that is going to be the only credit in the economy, but it must create the demand for private credit, which will then issue. And that's exactly how the situation worked over the course of the recoveries in the 30s and in preparation for the war. And that's what these national credit systems, national credit banks, and these international development banks, that's what they will do. And we must have Glass-Steagall for the second major purpose, that we've got to have our private banks, our commercial banks, participate in this this intense period of investment of new national and international credits into high technology infrastructure. You cannot, for example, think of issuing the credit in this country to build a real across the country high-speed rail system, electrified high-speed rail. That will require the participation of many, many private banks making loans to literally thousands of contractors working on these great works. Otherwise, are we going to have every company that is going to make surge protectors for the overhead electrical cables for certain sections of the high-speed rail lines? Every company with a job even as small as that is going to borrow the money to do so from the federal government? Obviously, we cannot have projects pursued and done efficiently, high technology projects rapidly in that way. The private banks have to be fully participating. That's what commercial banks do. That's what they have done historically since Alexander Hamilton's and his partners' first formations of commercial banks in the United States in the early 1780s. That's what they do. They will be restored to that function by being reorganized under Glass-Steagall. So that's essentially why Glass-Steagall is the first punch, so to speak. It's a punch in the gut to Wall Street and the City of London to take the dollar away from them, to take the credit system away from them. It will cause a breaking of their power. And then we are able to use the dollar and our national credit system to collaborate, both to build what urgently must be built in infrastructure and technological progress in this country and create millions of skilled jobs in the process, but also to collaborate in the tremendous chances that we're being given now, that we are being, over the past week, invited into these international development banks that are being formed, and that we have the opportunity for our economy and the European economies, again, to really grow. So let me leave it at that. And I think because of the way we're doing this, I don't really know if there are questions, but perhaps Gene can tell me.
Okay, so what I'd like to do is just remind people that if they do have a question, they can email to LaRouchesuforLaws@gmail.com. That's LaRouche's, the number 4 laws@gmail.com. And I do have a couple questions that have come in already. And and then the people that are on the call-in line, it'll be difficult to communicate with them, but at some point I might let them get in a queue and see. I'll start the queue and see if anybody has questions there, and then if they don't have the ability to email, maybe I can cut in and take a question or two from the people on the telephone conference line, and then relay that to Paul.
Okay.
So what we'll do first is I've got a couple questions that have come in already, and while other people might send in some questions from what you've already said to LaRouchesupport@gmail.com. So I'm going to turn on the queue for people that are on the conference line in case somebody wants to get in line there. So the first question, Paul, is well, I'll ask both questions. One is more conceptual, and one is you might say technical. And the first one is we used to have a Bretton Woods system that was a fixed exchange rate system, and how does what you've described, how does that relate to what we used to have with Bretton Woods? Is it better than? Is it different than? Is it the same? How does what you're discussing relate to what we used to have under Bretton Woods and the fixed exchange rate system? And then the second question that's come in is this idea of bonds. You hear people talking about it. What is this use of bonds? Is that private credit, or is that government, or it can be both, either private or government? And just explain bonds so that people who hear that term have an idea of what some banker or financial person might be talking about.
Okay, maybe I'll obviously take the conceptual question first because such questions are easier. But Glass-Steagall, remember, was part of the Bretton Woods system. We had a fully enforced Glass-Steagall Act in force well past the end of the Bretton Woods system, and it was created that system was created on the impetus of primarily of people in Franklin Roosevelt's administration, and so Glass-Steagall was absolutely a part and parcel of it. The purpose was that the private banks, the commercial banks of countries who were members of the Bretton Woods system were to be issuing lending, putting bank credit by lending primarily, and also by buying corporate bonds. So we're beginning to peak towards the next question too. But they were putting that credit into their domestic economy. And if the credit was going into other economies, it was going through treaty arrangements like, for example, the Marshall Plan, which was a very, very effective, although it was not very big and it didn't last for very long, it was a very, very effective rebuilding tool. And the crucial reason that it was effective is that we were not in the Marshall Plan pouring dollars into broken European economies shattered by the war, where the dollars would become speculative instruments and would all wind up in Swiss bank accounts and be used to pay the war debts of the London and so forth. Rather, we were issuing credits which were used for the most part to buy technology exports from the United States. So we were issuing credits without dollars leaving the United States, and the lending that was going on in the Marshall Plan was overwhelmingly lending of private banks in the United States to companies in the United States which were helping participate in the rebuilding of particularly the German and Italian economies. So, and then Germany in particular created a credit bank of its own, the Kreditanstalt für Wiederaufbau. It was called KfW, as it's known still today. And that bank was extraordinarily effective in using the repayments which were made by German borrowers under the Marshall Plan, not to go back to the United States, which was already benefiting by exporting all these goods, but rather using those repayments to the KfW bank to create additional new lines of credit within the German economy. So that the idea that banks loaned internally was, and that there were controls on currencies moving across national borders, and there were controls on capital also. These were part of the Bretton Woods, a crucial part of Bretton Woods, and Glass-Steagall was very complementary to them, and the Glass-Steagall principle was assumed under Bretton Woods. We should also remember that France enacted a Glass-Steagall law in 1945, and during the period of the Bretton Woods system, French banks were separated in the same way as they were here, and limited. Commercial banks were limited out of the securities sphere in the same way they were here, and this was true in other countries in Europe as well. So it was a crucial part. It was crucial that banks that essentially under Bretton Woods, you could not open an account in dollars outside the United States unless you showed that that account was for purposes of paying in trade, in export and import trade, and that you were buying and selling things, producing, buying and selling things, and that those dollars were deposited abroad in order to make payments. Otherwise, you couldn't do it. And the Eurodollar market was a direct violation, which the regulators allowed to happen. And that was what Kennedy was trying to reverse in the short period of time that he was president. Put the capital controls and the credit control and the currency controls back on in order to stop the dollar from becoming an international currency of London and Wall Street instead of a currency of the United States. Now, in terms of the bonds and the loans, most of the loans, large loans which were made in the period of the Bretton Woods system, were loans from one country to another. Most of the small loans were loans from commercial banks to businesses or farms or households. Securities, bonds are different. Bonds are securities. You can buy a business's bond. You've loaned the money for sure, but you can then take that bond and sell it to somebody else. The existence of a secondary market, which should not exist for loans, the existence of a secondary market for bonds identifies them as securities. Now, what these new banks are doing, the International Development, the AIIB, and the New Development Bank, which are just being formed now, is those countries are putting capital into those banks. That is, they are, you might say, investing stock in those banks. And that will give those banks the capital to make a couple of $100 billion worth of loans for infrastructure projects. As I said, it's a tiny amount compared to the need, but they'll get bigger. Those banks might then turn around and offer bonds to bring other large investors into the bank or to bring other countries into the bank. But so far they say they're not intending to do that. They're intending to bring in other countries as stockholders in the same way that the 5 BRICS countries are now stockholders, and China and some other countries are stockholders in the Asian Infrastructure Investment Bank. They intend to bring other countries in as stockholders with specific shares of the bank. That's the way Hamilton's Treasury Secretary, Alexander Hamilton's First National Bank, was done, and that bank did wonders, created miracles for the very early U.S. national economy without issuing bonds, simply by the investment of debt securities into the bank as stock. So hopefully that's the way these banks will be able to build up very large capital and credit capabilities on the basis of nations coming in as equity investors, stock investors into those banks. I hope that's useful.
Okay. So what we'll do is we'll take the next question that's come in. There were some technical difficulties. Some people got cut off from the free conferencing, but I think we're back up and working. But we do have a couple questions that have come in the meantime also. Let me go through the first one. The question comes from Deborah saying, people are so deeply invested in Wall Street through their retirement plans and investments that I can hardly imagine they will rally behind bringing down Wall Street through reinstating Glass-Steagall. What do you see people doing with these investments in preparation for Glass-Steagall or after Glass-Steagall's passed? If people aren't offered any alternatives, I think fear will immobilize people to want to do anything differently. So I'll let you take that one, and then I'll be back with another one after that.
Well, this is like any kind of situation where somebody says, well, you can't do away with this criminal enterprise because I'm involved in it. They're helping me out in some way. And, you know, the more criminalized an economy or a nation is, the more people you will find who will say, well, you can't take on this organized crime, this criminal enterprise, because they're helping me out in some way. But people who have their retirement investments in 401ks and so on and so forth, and particularly had them prior to 2007, had them invested in heavily in stocks. You know, there used to be a formula, I'm not remembering exactly what it is, but X percent of bonds, X percent of stocks, X percent of cash, usually meaning U.S. Treasury securities. People who had, you know, and the more the stock boom goes, the more the advisors tell you should be 50% stock, 60% stock. You should be down to just 20% cash and bonds, all the rest in stock. What happened to those people in the crash of 2000, 2008? Their retirement savings were cut by 50 to 75%. That's the reality of it. If they say my retirement's dependent on Wall Street, they're not thinking. They're not thinking about what just happened and what's about to happen again. Obviously, we are providing an alternative. We're providing a situation in which both employment and savings from employment and investment in various kinds of goods producing activity by a person who's relatively passive, who's retired, or who is working and has some savings, that will bring returns. You have a situation now created by the Federal Reserve and the other central banks' policies where you cannot invest in any fixed income investment at all because you simply won't make any money at all. So the only thing you can, because interest rates are zero and all the interest rates based on them are at 1% or less. And so people are being forced back into stocks, into Wall Street. But in fact, despite the fact they're being forced, you can see from the data on stock trading that still a very tiny fraction of investment in the stock market is coming from savers. But they are being forced, and they're going to be forced into another crash. And this is the reality of it. They thought they were dependent for their retirement security on Wall Street 10 years ago. Then they found out 50 to 75% of it is gone. Now some of that, part of that they think has been recovered, and they're dependent on it again, and the same thing is going to happen to them again. What we are talking about is the only alternative to that.
Okay, so I'll just remind people that if you have a question, you can send it in to LaRouchesupport@gmail.com. That's LaRouche's, the number 4, laws@gmail.com. And so I'll take the next question that's come in. This one from Matt says, is the Glass-Steagall that's brought up now by and sponsored by Elizabeth Warren and John McCain any good? I don't trust McCain. He's such a warmonger. I can't trust him. Plus, the things I've heard about Elizabeth Warren don't get me excited about her. So, are they promoting a watered-down version of something just to suffice the population, or is it actually real? Can you say something on that?
Well, the primary thing I can say is that we created the situation in which those bills were introduced. I mean, I told you about Carter Glass. The miracle of Glass-Steagall is that Carter Glass had anything to do with it. Nonetheless, that law, Roosevelt's Glass-Steagall law, prevented bank panics in this country for 65 years and created a deep commercial bank-based capital market, which propelled U.S. growth beyond the growth of most countries in the world for the better part of that period. That all came from a character who Steagall wanted deposit insurance. That was his big thing. He had been pushing it before the crash of '29. And Roosevelt was the real force here, and Carter Glass went along with it. As I said, it's in part because Roosevelt and Pecora, with the impact of the Pecora hearings, wiped out the top leadership of some of the biggest banks, and it was replaced by people with a little more sense who wanted to break their banks up and did so. So there you have the miracle of Carter Glass's name being on Glass-Steagall. I don't think that Elizabeth Warren or John McCain is the father of the Federal Reserve or Wall Street's man or woman in the Senate as Carter Glass was. So we got to look at what the bills are. And if they restore Roosevelt's Glass-Steagall. The bill in the Senate and the bill in the main bill in the House do that. The bill in the Senate adds to that a more detailed definition of things that commercial banks cannot invest in. And they added that because they wanted to make crystal clear that they could not carry derivatives exposure. And derivatives exposure as such was not a subject of the original Glass-Steagall Act. So they added that, makes it a little bit longer and more detailed, but otherwise that is, and so is the House bill, the Glass-Steagall Act.
Okay. So the last question that I want to ask, that's what is these developments in Russia, China, and India? Obviously, they're not using the word Glass-Steagall necessarily in their recent BRIC meeting, but are they moving in the direction of Glass-Steagall, and how can this meld together with what you're proposing and what Mr. LaRouche has laid out with these 4 laws?
Well, it would not do any good to get into detailed discussion of the characteristics of those economies. The one most like ours, obviously, is India's economy, and in terms of its forms. And yes, there is discussion in India of separating some of the major banking groups from their securities activities. In China, the issue does not really arise because a tremendous amount of credit that China is making available, not only through these 2 new banks, but it is putting out credit all over the world for infrastructure development on simple bilateral treaties, nuclear development, high-speed rail in particular. They're trying to build 50 or provide the credit and the engineering to build 50,000 miles of high-speed rail outside the borders of China. So what they're putting into these investment banks is actually smaller than what they're already investing, and that's coming through state banks in China, which of a sort which we don't have. So it's not really an issue of whether to break them up. The point is that we have got to get a greenback dollar. That is a dollar which is issued by the Treasury into a banking system which is controlled by the Treasury and into some kind of national credit instrument, a national bank, a Reconstruction Finance Corporation, as with FDR, an instrument which can direct much of this credit into the most urgent and most productive high technology infrastructure projects. That gives us control of the dollar system again if we create that kind of greenback dollar. And I think I already discussed why the private banks have got to be reorganized again under Glass-Steagall in order for them to participate. The conditions are somewhat different in China, in Russia in a different way, somewhat more similar in India, but those countries, as well as Brazil and South Africa, all have national development banks. That is, they all have created national credit banks whose purpose of their credit is these kinds of infrastructure and productivity investments. So the invitation is absolutely wide open. It's been made formally by these countries to the United States, and it's absolutely wide open politically for the United States to get into these development banks. And again, as I said at the beginning, if we oppose them, then we create a situation where the danger of their development is that it may grossly devalue the dollar and leave us unable to generate, or much less able to generate the kind of credit that we need. So we need to get into them now, and we need to get Glass-Steagall through to open that door.
Okay, so I think this kind of a discussion that we're having here tonight is really giving people a foundation. It's not that they're going to talk about everything that you've talked about in every discussion that they have with everyone, but it definitely gives people a foundation and an understanding that we do and you can understand how an economy is supposed to work, as this first idea of Glass-Steagall has to come in. You know, once we've removed Obama, we put in this Glass-Steagall as the first step. It really gives us a foundation to stand on, so that when we're out talking to other people in the streets, when we're talking to our congressmen, our senators, and representatives, we're really building up within ourselves an understanding that Wall Street doesn't want us to have. If there's anything that Wall Street doesn't want people to understand, it's the necessity of Glass-Steagall, it's the necessity of the national bank, the necessity of the credit system, the greenback credit system, and this fusion-based system. So tonight's discussion, which really takes on the first part of this, is in kicking off this four laws discussion, is really helpful to bring about a platform for all of us that are the activists to stand on. So at this point, the questions that are coming in, I think next week we'll have a better idea just of how to make this work. We've kicked it off in a very good way. We've had somewhere in the range of between 50 and 100 people that have taken place in on this call tonight, and on the line, and on the YouTube video. So if you have any parting remarks to make, Paul, go ahead and make them, and then we'll close out the session.
No, I'd really just like to thank everybody for participating, and I think we all just need to mobilize. This is just ammunition that we have in order to understand exactly how to force Congress to do these things and to enforce them. Both to get them implemented and also to be on top of enforcing them, because of the tremendous benefits to the nation, to the world, of getting Obama out and getting these kinds of policies legislated so that they can be implemented. And the jump start that's been made by the formation of these new international banks and the tremendous growth that we're seeing from some of the countries involved in these banks, I mean, in a sense, they are able to jump over the Glass-Steagall step because they're not starting from currency and credit systems which are controlled by London and Wall Street to begin with. They're creating an alternative to that. We can't jump over that step. We've got to destroy the hammerlock on the dollar and our credit by London and Wall Street. That's why Glass-Steagall is irreplaceable for us. So let's get it done for that broader purpose of the 4 laws that LaRouche laid out in March.
Okay, thank you, Paul. And those people who've, if you still have questions, you can send them in to the email associated with this. This video will be posted on YouTube, so you can still send in your questions. I see there's a question that's come in, but we'll forward that to Paul. And with that, we'll end the broadcast, and we'll be back next week with part 2 of this series. Good night.